let's talk about another accrual account. Now, accrual account's purpose, if you'll turn back to page 3.1, accrual account's purposes are to mark down the asset accounts. Accumulated depreciation that we've been talking to about so far marks down what type of account? Property, plant, and equipment, right? Okay. So, and for every property, plant, and equipment account we have an associated accumulated depreciation account, right? Okay. Now, there's another account that I want to spend a minute on, and that is account number 389, bad debt allowance, also known as allowance for bad debts. I mean, it has those different names. Okay, same thing, calculated the same way. What allowance for bad debts does is it represents what you think of the accounts receivable is going to eventually be written off. So this account right here, 389, is tied to the receivables. Out of that $5,072 in accounts receivable, what does that represent, first of all? What does that represent, that balance? What customers owe us, okay? However, what's the chances we're going to collect all $5,000? Not likely. Yeah, we like to. We'd like to. But we don't think we're going to collect it all. We know it's just the nature of business, and we take a risk when we sell something on credit. And we're willing to take that risk. And so we know some of that's not going to be collectible. The purpose of the allowance for bad debts is to estimate which part's not. So out of that $5,072, we actually think, we estimate, we guess. And it's hopefully better than just a guess, that we're not going to collect $500. We actually think we're going to collect around $4,500 of that. Now, we don't know which ones of those $5,072 we're not going to collect. If we knew that, it shouldn't be in there anyway. It shouldn't be in that accounts receivable. We need to write it off. We need to get it out of there. So, let me give you an example. Had a client that had a whole bunch of receivables. And he gave me a long list when I first set him up of all of his receivables, all the customers and so forth. So I set him up in the system, went through the effort of doing that, and then I brought him a stack about like that of statements. And I handed them to him. And he, right there in front of me, starts going through them. Every once in a while, he'll take one out and throw it in the garbage can. Throw it in the garbage can. So he had several in the garbage can. Most of them he handed to his secretary and asked her to send them out. What's that? He said, those are people it's not even worth putting a stamp on. I've given up on them. Now, when it gets to that point, get them out of there. Okay? They shouldn't be in accounts receivable at all. When it's not even worth 33 cents, get them out of there. That tells you they're worthless. Okay? It doesn't mean give up. It means send them off to a professional collection agency maybe. But get them out of accounts receivable because you've given up hope of ever collecting it. Maybe they took out Chapter 7 bankruptcy and you were an unsecured creditor where it means that you don't have anything to claim. You're more or less out on that. And if that's the case, or maybe it's for a small amount and they've moved, there's no forwarding address. Every time you send it, it gets sent back. And you don't want to spend the time to go out and try to hunt them down because it's not worth the time. Get them out of there, okay? So this $5,072, although it might include some people that we're starting to wonder, we haven't given up all hope for, it's still worth a stamp on every one of those statements. But we know there's some of those customers, maybe they're 6 months old, and they just, they don't think they're going to pay us. But we don't know for sure. We're going to continue to send them statements. As long as we're going to send them statements, we're going to leave them in there. Okay? But we want to estimate down here how much we don't think we're going to collect of that full amount. Now, the reason this is so valuable is because it tells a story. I mean, if half of our receivables are we think we're going to give up on eventually, is that important to note? Yeah. Because if we don't, it says we're telling everyone that, or ourselves, we might be fooling ourselves too, that we got $5,000 worth of assets. When in reality, we know we're not going to get $5,000 from those. What's that? The things that they're going to write off half? Yeah. So anyway, that's the purpose of bad debt allowance. Now, how do we calculate it? There's two methods. The preferred method is the first one. However, it can't always be used. And the preferred method is called historical percentage. And it very simply said is we use history to estimate what's going to happen in the future. If we have 2 years of historical data, and that tells us that in the last 2 years, we have written off 10% of our sales on account, we are then going to guess that probably in the next 2 years, we'll eventually write off 10% of our sales on account. Okay? Now this is how it would be calculated. We would take how much we've written off. So these are our write-offs. And we would divide it by the total sales on account for the last 2 years. Okay? So if we wrote off of these, if we gave up on $20,000 of these receivables, we just said it's not worth the stamp anymore. We've given up, and it was $20,000, yet our total sales on account for that same period, the 2 years, is $200,000. Then what it says is we wrote off 10% of our receivables. Now, if we use history to tell us the future, that means that any sales we make this month on account, we estimate that 10% of them are eventually going to get written off, right? Now, we don't know which ones that we made this month are eventually going to be written off. We're just using it as a guess, an estimator, okay? So if our sales on account in this month are $10,000, and we estimate that we're going to eventually write off 10% of those sales, how much do we actually think we're going to collect of this month's sales? $9,000. Okay? So this month we're going to make an entry, and we're going to increase that allowance for bad debts by 10% of $10,000 or $1,000. Okay? And every month we'll increase the allowance for bad debts by 10% of that month's sales. Do you follow that?
What happens if you collect 8%?
Okay.
If you only lose 8%?
Okay. And it might be that this month maybe we will only lose 8%, right? But next month maybe we'll lose 12%. Okay?
How do you put it if you don't have 2 years?
That's the problem. Okay? Sandy said, what do you do if you don't have 2 years of history? And that's the reason why you can't use it all the time. Okay? Because when you're just starting up with a new business, you don't have 2 years of history, or oftentimes you come into a business that they haven't been keeping the data in such a way that you could pull it out to figure out what it is. They haven't been writing stuff off. You know, I've run into this a lot of times where they'll just carry customers on the books forever and ever and ever and ever and ever. They've given up hope on most of them. You got $10,000 in receivables and 8,000 of them they've given up hope for. Okay? And so they just haven't been able to keep the data together for you. Now this method then, in order to use this method, what do we have to first have? 2 years worth of history. Okay? If we don't have 2 years worth of history, then we're going to have to use a second method. And the second method is called over 90 days past due. Very descriptive. Over 90 days past due. Very simple system to use, can be used within 3 or 4 months of the time the company starts business. Up until then, it takes that long for it to be able to get over there. Have you ever seen, how many of you have seen an aging report for receivables before? A few of you have. Aging reports are very consistent. with computers, they're a piece of cake. You just push a button, okay? And it prints out an aging report. And that aging report will show the customer's names listed down here. And then it will age their receivables into 30-day categories. 0 to 30 days old, 31 to 60, 61 to 90, 90 to 120, and finally 120 plus. Okay? What's that? Well, it looks like sometimes the bottom of the statements, too, will have these same breakouts, won't they? And what it does is it then takes the receivable balance for each of the customer and puts it in these columns depending upon how old it is. Now, if they're in here, they're all current, aren't they? Okay, because they're less than 30 days. And assuming that they have 30-day terms, anyone that goes from here to here is going to be past due, aren't they? 1 day past due to 30 days past due in this column, right? So if their amount is over here, which hopefully there's very few, but if their amounts are over here, it means that they're over 90 days past due, right? If they fall in here, okay? And so anything that's over here is going to represent or is going to be included in the allowance for bad debts. So if this total number is $500, that's how much your allowance for bad debts is, okay? Now next month, might one from here jump into here? And if it's $200, we're going to increase the allowance for bad debts by that $200. What if one that's in that over 90 days pays us? Then it's going to go down, right? Okay? It's going to go down. And if it goes down to $300, we're actually going to take $200 out of that allowance for bad debts. Okay? So whatever that last column, do you see how easy this is if you just push the button and get the report out? Okay? Very simple system. The value to this is, any collector will tell you that once a receivable gets over 90 days past due, the chance of collecting it is very remote. Okay? And that's a magic number in the industry. And so they'll tell you, beware of that. Well, we want to tell management how much of that $5,000 or $10,000 or $20,000 in receivables has moved into that column so that they can watch it. Plus, it's numbers we can get real easily. Again, two simple methods to use in calculating. Which one's preferred? The preferred method, which is the historical percentage, okay? And if you don't have the history, then you'll use the over 90 days past due method, okay? So very clear guidelines, very easy to calculate. And also, by the way, one other thing on the historical method, every year you've got to go back and reevaluate, okay? So you'll include the previous 2 years. Each year you'll be adding 1 year in and taking 1 year out. Small businesses are notoriously poor at collecting receivables. Anyone know the reason why? Customers are their friends. And that makes it more difficult. It's not really in there right now. That makes it more difficult to collect from them. Okay? And so, because now you've got to not only deal with the fact that you might lose a customer, but you could lose a friend, and so they hate doing that. They procrastinate. So I'm going to tell you 3 things that every small business owner should be doing, and some of them are going to be very logical, and you're going to say, well, I knew that. But on the other hand, when you get out to small businesses, you're going to be surprised to find out how few of them do them. Okay? If you've worked in a big business accounts receivable office, for instance, you know you send out statements, right? Many small business owners don't. They assume that their customers' records are better than theirs, so they're just going to pay it just out of the moral, obligation to pay it. And so you might be in a position to help. And I've run into a lot of clients like that. Now let's start out with the first thing that every small business owner should be doing. And I call this my bump system. The B in bump, and by the way, it's bump without U, okay? There's no U in it, it's just BMP, but that has a meaning. You have to be very careful if you're in a freelance situation of what you do with your company letterhead, company cards and so forth. Unless you're a licensed collection agency in the state, you can't start calling your clients' customers and say pay. You've got to be licensed to do that. Now, if you are an employee of the business, if you're working for the business, you can call all you want. You can call every 3 minutes. You can use your name, and you can use the company's name and all that. Now, the bump system, the B, stands for blame it on the accountant. I give presentations to small business groups quite often, and there was an insurance group of insurance agents. Now, some of you might have been involved in insurance before, but insurance agents are between a rock and a hard place here. Oftentimes they have, this is not Farmers or State Farm, this is the independents. They have agent billings where they become the collector from their customers, okay? So they're between the insurance company and the customer, and they got to go get the money from them. That's called agent billings. Now do they have to keep a good relationship with their customer? It's just like a paperboy. Least favorite job is to go out and collect the money, right? Okay? And that's the same thing with insurance companies. His least favorite job is agent billings. So they asked, at the end there's always a question and answer. They asked me, how do we improve our collections of agent billings? And I told them, blame it on the accountant. Now I can tell you, a lot of those insurance agents did not have an accountant until that meeting. Now they've all got one, okay? Because this is such an easy, it's exactly right. And what it stands for is now can you make a phone call if you're doing freelancing? Can you call the customer? No, you can't. Unless you're a collection agency, you can't call the customer. So they're going to have to call the customer, right? Okay, they're going to have to call them. They're going to have to talk to them. And the most effective collection procedure is a call from the owner. No question. It is the most effective of all collection procedures. Get the owner on the phone. The problem is you got to get them over this idea that they're going after this customer, their friend. And so you instruct them, tell them, you blame it on me. Here's a list of all the customers you need to call. Here's their phone numbers. Call them up. Tell them I'm bugging you about it. Okay? Then they call the customer and they say, hey, Jack, how are you? How's your family? How's everything going? It's good to hear from you. Listen, my accountant just called me. And he asked me to call you. I told him everything was all right. Okay, you're going to pay. You're good for it. But he just asked me to call you. Okay? Now, who's the bad guy here? The accountant. Okay? He's still a good guy. That's all right. We want him to be a good guy. Now, I always instruct my clients, don't use my name.
Yeah.
I don't want him to know who the bad guy is. I'm just the accountant, okay? So, yeah. No, don't do that. Because that kind of robs him of the whole reason why you're doing this. Because if he calls me, I'm going to be a nice guy again. I want him to think I'm ruthless, you know? Sort of like when the boys come to pick up my daughter. I want them to think I'm mean, you know? So the accountants become the bad guy. I had a orthodontist that was working on my son's teeth. And when we sat down, he had to have some extensive work. And so we were talking about making payments on this work. And he did it beautifully. He said, my accountant makes me do it this way. You know, I don't have a choice here. He's a mean guy. He makes me do it. And so we, you know.
Did you say, hey, I can be your accountant?
I could have, but I knew exactly what he was doing. I knew who was the boss. He's the boss here, but he's just trying to say, I'm a nice guy. I'm here to help you. It's the accountant that's a mean guy. And if I didn't pay my bill, I would expect him to call me up. And he probably would. And he'd say, hey, my accountant just called me. Asked me to talk to you. I told him you were all right. Don't worry about it. But I told him I'd call you anyway. Okay? Now, if I didn't pay you next month, I would expect him to call me again. I expect him to say, hey, my accountant just called me again. I told him to lay off for a little while, that you'll get it paid. He's saying something about a collection agency. I told him not to worry about it right now. And if I don't pay him another month, I'd expect another call. Hey, he's threatening to send you the collection agency. You know, I told him that you really worry about your credit and you don't want to get it. So I told him I'd call you and just let you know about it. Would you please get him off my back? Okay? See, who's the bad guy through this whole thing? He is, okay? Or she is, whoever. And just as long as they don't use your name, you feel comfortable with that? Yeah, okay? See, another reason why I don't want to use my name is just in the event that they know who I am. I don't want them to pick up the phone and say, Alan, get off his back. You know, I'm going to pay you. Because, again, that eliminates the whole value of having a mean person out there. They understand the excellent way. Blame it on the accountant. Secondly, remember, it's bump without you, and M stands for mail statements monthly. Same time, every month, like clockwork. Don't miss a month. When you miss a month or you send it out 2 or 3 weeks too late, it's counterproductive. People pay off of statements. When you don't send statements at all, a lot of people don't pay, and it's not because they don't intend to pay you or don't want to pay you. It's just simply they didn't pay you because that's how they pay, is off statements. Hey, I mean, how do we do it? Usually you have a cubby hole someplace, you just collect statements in there, and then once a week or once every other week on payday, you sit down, write your checks, right? And when all the statements are gone, you put the checkbook away, you're done. Piano teachers are terrible.
I was the piano teacher.
Did you send out statements?
Heck no.
Yeah, see?
Just wrote it.
And what was your biggest
Maybe
problem?
ahead of time.
What was your biggest problem? Oh, that helped. That helped. Okay, but most piano teachers, biggest problem piano teachers have is their students' parents don't pay them.
That's right.
And they're sitting there saying, these no good bums are not paying me, when in reality, it's not that the parents are trying to avoid it. I mean, some do, obviously. But it's because they just don't have a statement. The final one is P, and that means past due amounts. If a person is past due, don't just send them a statement without doing anything. Just very simply, you can buy a past due stamp, rubber stamp, ink stamp from the office supply store. Get a rubber ink or red ink pad and just hit it past due. That might be all you have to do for small amounts. If it's a larger amount, like it's over $300 or $400, then I would recommend a letter go with it. You know, just a kind letter first, and maybe a little bit more threatening as time goes by. On whose letterhead?
Theirs.
On the company's. Why not yours?
Because then you got your name.
That's one thing, and the other thing is
It's not professional.
you're not a licensed collection agency. Now, that's the bump system. Make sure that all 3 things are being done, okay? Blame it on the accountant. Let them know that you're willing to allow them to blame it on you if there's any problems, if they need to collect. Get them to call, but let them blame it on the accountant. Secondly, mail statements monthly. And third, spend time on those past due amounts, even if it just means hit that statement with past due on the statement. Just to point out, see, because of 2 statements, if one of them's got color that says past due and the other statement doesn't, and they're just limited resources to pay them, they'll pay the one that says past due, okay?